Welcome to Investment 360. In the hot seat this evening, George Herman from Citadel. George, appreciate your time, and we're hoping that you are going to give us some good news this evening in terms of asset allocation and that it's not all doom and gloom out there. How are you feeling about the current market environment?
You're 100% right, Bronwyn, that it does feel like a bit of doom and gloom out there, but it's not that bad. The world is essentially worried about three things. Firstly, it's worried about the European debt crisis. It is worried about whether we're going to have a recession in the United States again and whether we're going to have a hard landing in China. I think the consensus view right now is probably that the worst case scenario is happening for Europe, and that America is definitely going into a recession and that China is on the way down because they can't maintain the good news. I don't think it's that bad. Whatever happens in Europe, there's a lot of noise now, and I'm not going to try and explain exactly what's going to happen in Europe because nobody knows, but a solution will be found. In terms of the US, we don't see a second leg to the recession in the US at all, and I'm just back from China, and I can assure you there's not a hard landing on the way there at all. So we are not as negative in terms of the world as maybe the consensus view right now.
So George, how do you position yourself against that backdrop, where you're not going to have a recession in the US, where China will, where Europe will bumble through, and where we're going to get growth in China?
A soft landing, in other words, in China.
Soft landing in China. Unfortunately, China is not going to save the world in terms of overall growth. Global growth will slow down. Global growth will be tough. We can see that Europe can go into a recession. So yes, growth will be pedestrian. However, at Citadel we're value managers. So typically in a time like this where there's a lot of noise and a lot of fluctuation and volatility in the market, some nice value opportunities come through. So it's a matter of cherry picking in terms of your asset classes, in terms of the individual asset selections. But just be patient. We don't have to be in a hurry here. There's still a lot of tough things we have to work through. So there's a lot of opportunities to get great assets at great prices. I think Mr. Buffett recently showed us how being very patient, he picked up something that he's probably been waiting for 10 years.
George, so what's your equity exposure? I mean, in a typical portfolio, if you're saying that there are opportunities, what's your exposure to equities at the moment? 50, 55, 60, 65 in a typical portfolio? And you know, David, what we're trying to work to is how you allocating your the cash, you know, amongst the various asset classes.
Indeed, David, thank you very much. You know, at Citadel we have a wide variety of products, and each client is catered for individually, so there's not one answer that's correct for everybody. But in what we refer to as our house view portfolio right now, we are extending towards the maximum end of equities, where equity allocations is up to 70%, of which 49% is international and 21% is
so
in South
big
Africa.
Offshore exposure on the equity front. Where specifically are you finding that exposure? We
believe that developed market equities still offer better value than emerging market equities. On a valuation basis, emerging market equities is only now, after some underperformance, becoming relatively cheaper on a PE basis than developed market equities. So we still prefer that during these uncertain times,
developed market
the
equities.
Cap, the bigger companies abroad.
George, developed market equities are a big grouping there.
The uncertainty.
I want you to drill down into your preferred developed market.
So there's not a single market specifically.
I think maybe George can't hear me.
Value around so.
George, can you hear me?
Yes, I can.
I was just saying that when you talk developed market and emerging market, those are very big plays. So I want you to be a bit more specific in the developed world. Of course, because we're dodging bullets here on the international front. Where specifically have you got appetite for the developed world? And you know, you quoted Buffett earlier, just looking at that whole old adage, buy when others are fearful, sell when they are greedy. I've been saying it ad nauseum on the desk at the moment. Let's just say, would you take a plunge now on European banks? Their market cap is less than that of Apple combined.
It's Bronwyn, it's maybe a bit early to get into European banks. Just after yesterday, I mean, we saw the German banks being downgraded. The big risk still lies inside the French banking system, which is very worrisome. So it's maybe a bit early there. But yes, there is some value in the financial sector in Europe. That is one area where we're going. But in the general industrial area, there's a lot of opportunities in Europe because they are being marked down on the back of risks immensely. So at the moment, we think that the US will lead the world out when growth does eventually resume. So first choice Europe, US, and second choice Europe.
George, are you buying funds or are you buying individual stocks? And if you're buying individual stocks, if you can just give us a feel of what kind of stocks you find value in.
David, we only invest in funds or with fund managers specifically, and we specifically go and look for value managers because that is our overall philosophy. So we are invested with managers. So in terms of the single stock picks, we rely on their expertise. The type of stocks that come through that we see in the portfolio are things that are quite defensive. You see the Nestle, Johnson & Johnson, Maersk. Those are the type of companies that come through in the portfolio.